Good afternoon, everyone. Thank you all for joining us for our continuing Resource Network webinar series. As always, we're excited to be bringing the webinar series to our members and invited guests. All of the presenters speaking in this series are part of our Resource Network. They've all made a commitment to provide our membership with actionable insight into areas that can help them grow or otherwise impact their bottom line in a positive way. While webinars like this are the start, all of the members of the Resource Network are available to come speak to your groups individually and get a little bit more granular with their content. Before I introduce our speakers, I should go ahead and answer the most popular question we received during these webinars. Yes, we are recording this, and yes, we will make the slides available to you. We will send you an email after the presentation. You'll have the slideshow. We'll give you a link to our YouTube channel so that you go ahead and watch this series again or invite other people to it. Everyone will remain muted during the presentation. However, please use the Q&A button throughout, whether it's during our presenter or our presentation. Put the questions up there so that at the end, we'll only have about 5 minutes and we'll try and get to as many as we can. Our keynote speaker today is Michelle Bournstein, Solutions Manager at Virtual Partner Advantage. Michelle joined CFS in 2002 as a client support specialist to meet the business needs of their client base. Now as a solutions specialist manager for VPA, she specializes in developing creative solutions for clients that utilize Autotask, ConnectWise, QuickBooks, Quozal, QuoteWorks, or Southware. With her experience as a systems specialist, programmer, and project manager for a New Orleans-based reseller, as well as 16 years of consulting with technology clients, she provides a thorough understanding of the industry and a strong commitment to the success of her clients. When she's not working, she loves to travel the globe. I can tell you that Michelle is my go-to resource when I need help with the financials, the metrics, the numbers of running an MSP. Of course, webinars like this do not take place without the assistance of our valued partners and sponsors. For today, we have the pleasure of being sponsored by Unitrends MSP. The focus today is to help you understand the importance of having a backup and where Unitrends MSP fits into that play. We're fortunate to have General Manager of Unitrends MSP, Mike Sanders, with us today. Mike, good afternoon.
Good afternoon, Steve. Thanks for the intro.
Sir. No problem.
So appreciate the time. I'm going to take just a few minutes here to take everybody through backup, kind of the landscape of backup, how we see the landscape of backup evolving, and where we see really growth potential for MSPs. But I like to always start this off with there we go, with this image, and this is one that we get a lot of images like this, or a lot of stories like this, I should say. They don't always come with images, but this one was particularly interesting. We got this last year, at the end of last year, from one of our partners, and that partner had been struggling to get this particular client to buy backup for some time, and it was the kind of a similar story that you get sometimes, where they said, listen, we have kind of a basic backup, or I have a good enough system and I don't have time right now. And this guy really didn't have anything, but still was giving the partner this whole story about how they didn't have any time to spend on a backup solution, implementing something like that. So finally our partner went to this guy and said, listen, I'm going to actually send you a unit. We're going to deploy it there. I'm going to come out. I'm going to do the installation. I'm going to set everything up so that that there's not a huge amount of time associated with getting this thing up and running and everything else. Let me just do that. When you see that it's not having any sort of impact on your day-to-day business, that your servers are running fine, everything's good, it's not taking you a bunch of time to manage, then we can talk about it, because then he could remove that obstacle or that objection. And during that trial period, this guy shows up to his office and finds out that the pipe burst and destroyed everything he had. And so, super lucky on his part that he got through that and that everything was good. But it just highlights, people are still sometimes reticent to, really get in there and do a proper DRAS solution. And it takes some creativity sometimes to get there. And they certainly became a client after this. Moving forward from there, I like to talk really quickly about data loss and downtime. We're making so many advances with technology over time here, and unfortunately, despite that, and this pie chart got a little mangled there, but despite that, we still do a survey every year, not just of our clients, but of our entire database. And you can see from 2016 to 2019. We're not getting any better. It's still 30%, having data loss due to an outage. And on the experienced downtime last year, 58% versus 42%. So the 42% saying yes. And that's not really surprising when you think about what causes data loss. And a lot of people in their minds, when they think about data loss, they think about natural disasters and, tornadoes, things like that. But the reality of it is that most of the things that people run into out there are actually not related to that at all. So the biggest portion of this, and I apologize, some of these got moved around, but the largest portion that you can see here is human error at 24% and software failures at 22%, which is really just human error when you're writing code, right? So, this is the biggest chunk here. And then when we look at what everybody thinks about in the natural disaster section, we're really looking at a very small percentage. We're looking at 4%. And hardware error is already down to 5%. So even though we're making all of these advancements in hardware, if somebody goes and deletes something by accident, in that 24% of the human error, it doesn't make any difference, right? The other one that is obviously a growing threat is the ransomware and malware. And that is something that is, an ever-present threat, but it's even more so nowadays. It's growing, and it's going to grow, I would imagine, even more with this whole work-from-home environment where we don't have edge devices protecting us. But if we just look at kind of the traditional information around ransomware, you can see that it's been growing. From Q1 2018 to Q1 of 2019, we saw 105% growth, and we should get numbers on full year shortly. And the other part of this that was interesting is that it was a 93% growth in the amount that was paid. And so not only are the amount of attacks going up, but the number that each one of those attacks, or the money that each one of those attacks is generating, is going up as well. And one of the things that really drives this is, if you think about it, ransomware is, absolutely a crime that is easy to perpetrate, and nobody really goes to jail for it, right? A lot of these are done from locations where there's not a lot of enforcement, and there's simply, with cryptocurrency and some of the things that are out there, it's pretty easy to get away with this these days. And so if you think about it from the actual size of the market, cybercrime is a, even in 2015, and it's really hard to get numbers on these things, right? Because they don't file taxes on the money they're making. But in 2015, it was estimated that ransomware and cybercrime in general was a $3 trillion industry. And at that rate, that actually makes it larger than all of the drugs, different drug cartels and the drug trade in general. So it means that cybercrime is larger than heroin, cocaine, and marijuana combined in what they can garner from it. And nobody's dying from this, right? You have to risk your life to go and do this. And in fact, you can even subscribe to SaaS applications that other people update with full development teams to actually go out and do ransomware, where you just have to get it deployed onto people's computers, and when it makes money, you share some of that with the provider that created the ransomware for you. So it's pretty crazy, and it's come a long way. If we go back to the original kind of ransomware from back in the day, back in 1989, Joseph Popp, who was an AIDS researcher, went to conferences all over the world on AIDS research and brought with him a disc that had on it a form that you could fill out that would give you the risk factors for contracting HIV and AIDS for whomever you were interviewing. And he gave that to tons and tons of researchers, and over time, as they installed it, what it would do is it would wait till your computer rebooted for the 90th time, and it would encrypt all your files and tell you that you needed to send a check to Panama. So, obviously he got caught because there was a physical address, and, somebody just had to camp out and wait for him to show up to get the checks. But in today's world with Bitcoin and things like that, it's a lot easier. And as Bitcoin and the cryptocurrencies gain value as well, it's going to continue to drive a lot of this behavior. So I don't think we'll see this slowing down. And if anything, we're going to see it pick up. And as I mentioned before, with the lack of edge detection now, edge devices for a lot of work from home people, we should see an uptick there too. So we also get a lot of talk, or a lot of feedback. What about my customers that have moved to the cloud, that aren't using on-prem stuff anymore, that aren't doing servers and things like that? And this is an interesting stat. So 77% of companies that are using SaaS applications suffered data loss over the last 12 months. So it is still a very, very large segment of the user population that's going to lose data regardless of where. And it goes back again to if it's a software error, it doesn't really matter where it is, if it's in the cloud or if it's not in the cloud. And the biggest one, again, is human error. So people deleting emails. I'm sure everybody on this call has had somebody call them after they wiped things out of Office 365, or maybe they set the retention policy and things like that. And there's a common misconception that Microsoft or Office 365 or G Suite or Salesforce are keeping backups for you, but that's actually not the case. SaaS vendors only cover their own mistakes. So if you make a mistake, they're not going to fix it. So if we look at the breakdown of the vendor's responsibility, it's hardware failure, software failure, natural disasters, power outages, and delete requests. On the user side, it's everybody who uses the software. So if you're an Office 365 user, for example, you're responsible for any human mistakes, for any programmatic errors, any malicious insider activity, any external hackers, or any ransomware or viruses that affect that deployment. So it's a pretty broad spectrum of things that you're responsible for. And in the case of Salesforce, they actually just removed all of the backup functionality that they had. So now you don't even have kind of the basic stuff that they had in place before. And we're actually, with our spanning product, seeing a pretty big uptake of that product now as a result. And today's environments are getting more and more complex. So one of the things that I find really interesting is, if I look back a few years ago, maybe 5 years ago, the difference between what we would be protecting versus what we're protecting now is pretty drastic, right? You might have just had a server on site, maybe a small business server, and not a whole bunch of cloud stuff. Now almost every client is going to have something that is hybrid, right? They're going to have some public cloud, they're going to have some SaaS applications, and they're going to have some on-premise stuff. So being able to take care of all of that in one shot with one product is really important, because it gives you a much better ability to manage all of it, and it cuts the cost down for managing all of that when you have a single pane of glass, when you have a way that you can utilize workflow integrations and things like that to make your life easier around that. And it's one of the things that we really stress with the Unitrends products, and one of the things that we work on pretty much in every single release that we do. One of the other things that we've seen that's really interesting, this is from Markets and Markets. When we look at the growth of the backup space, we get 10% growth in backup from 2018 to 2022, and that's year-over-year growth. But it's pretty incredible when you think about it, because we typically would see 7 to 8%, which doesn't seem like a big difference, but when you're talking about a market size in the billions, it's a pretty big uptick. But the one that's really crazy and surprising on here is DRAS, right? Having that go from 3.1 to what they expect will end up at 12.5 billion is a massive year-over-year growth. And what we're seeing drive that is really an adoption of DRAS by smaller companies. So I'll give you an example. 5 years ago, if you had a dentist's office and you went to that dentist's office and they lost their local internet, or sorry, their local LAN, let's say, they lost their actual network, maybe their Wi-Fi went down, whatever their local LAN looks like. 5 years ago, they were probably bored at lunch, right? Today, they can't write prescriptions because those are all e-filed. They can't see who's coming in because they're probably using some sort of cloud-based provider that gives them access to that, and they can't do their digital imaging because that machine will no longer be available. Even if they just lost the digital imaging machine, it would be a big deal, right? How can you go fix cavities and things like that if you can't take the x-rays to see what's going on? And so with that shift, it's become more and more important for even small businesses to have the ability to have some sort of business continuity plan in place, and that's what we're seeing drive a lot of this currently. And it's not just about recovery either. So we're seeing a lot of companies use DRaaS for disaster avoidance. We had a hurricane that came up the coast of the US last year. It was the first time that we started to see a lot of managed service providers spinning up their clients proactively so that they could show their clients the value of having DRaaS in place before the event actually took them out. DR testing, being able to show your clients on an ongoing basis that you can meet the SLAs, the RPOs and RTOs that they're paying for. Patch testing, spinning up in the cloud or spinning up on hypervisors and or on our boxes, and actually testing to make sure that anything that you're about to do on a machine can be rolled back without having to have a whole bunch of extra equipment on site. And a lot of security use cases. A lot of the security testing people want to do, they don't want to do in a live environment. They can do this through the DRaaS or through just BCDR testing. So there's a couple of different ways that we see MSPs, or really 3 different ways that we see MSPs attacking this problem. One is a build your own, where you go and you build a data center and you're buying equipment. You got a large capital outlay. It's great because it's really it really allows you to design exactly what you want, and it allows you to design it with whatever SLAs you want. You can really spec this out however you want it to be, but there's 2 major things. One is the expense. The second is having an infrastructure team is while that's part of the expense, it's actually a little bit beyond that. It's difficult to find good infrastructure people and to run have those teams running and in place unless you have a pretty large organization. So what we see is a lot of people look towards public cloud, which gives you a little bit less on the infrastructure side. You still need to have some guys that are pretty solid on the infrastructure side, but it's not as drastic. But you still have a lot of expense on an ongoing basis, and worse than that, you have expense that can change depending on usage, with ingress fees and egress fees and things like that. So while you remove the capital expense, you still have a lot of questionable changes and things that you need to explain to the client around data change rates and how that's going to impact their bill, which is obviously not a great place to be. And the third option is to partner with somebody like a DRaaS vendor like Unitrends, where the entire data center aspect of it is actually turned over to them, and they have to make it their problem. So looking at some of the critical best practices that we see for this particular space and for backup from the MSP perspective, one is you should have a complete BCDR runbook that's built ahead of time. It's amazing to me how few MSPs have this. It's one of the things that really is different from our enterprise customers and the MSP customers that we run into. We have a whole process for onboarding where we set this stuff up and we make sure that everything is working properly and we know what the run book is. And when we go in with many managed service providers on the initial deployment, they don't have that in place already. And it's critical that you have that. You don't want to be writing the manual when the systems are down. You want to be able to go to the manual and figure out what the checklist is then. Another one is report weekly or monthly on your ability to meet the RTOs and RPOs. Builds value with your clients. It's an expensive service, and being able to show them that kind of data is really critical. Security is key for backup. We see a lot of people running backup on Windows machines, especially inside the same host on a separate VM than the other machines that they're protecting. And today, they're targeting that. When people get a hold of, when people are ransomwaring servers, if you're using the same AD credentials or you've got the exact same patch plan for your backups as you do for everything else, you're at risk. Your backup needs, are diverse, and so you need a solution that can cover all of those. And you need more than checkboxes and screenshots. If you're going to do backup testing, you want somebody who can automate the entire process of spinning up multiple servers, like spinning up an AD server, spinning up a SQL server, making sure that you can actually run SQL transactions, and showing that client that all of that will be available for them when they need it. And the last one is choosing a provider that can offer you the SLAs you need. Making sure that if you have clients that are in the police departments or healthcare, things like that, where downtime is a major problem for them, where it really has to be up and running within an hour, it has to be up and running within 24 hours. You want a partner that can provide SLAs for you, that doesn't just do a best attempt. And lastly, you want a partner that is going to make sure that the amount of time that you spend managing backups is as low as possible. And so one of the things that that Unitrans has done is we've designed something called Helix. It's actually self-healing technology that watches your backups, and if it sees some sort of a failure, it'll go in and do different things to recover from that failure and log all of that, so that you have a log of it and you can show that value again to the client. So I appreciate everybody's time today, and from here I'm actually going to turn it over to Michelle so she can move on to her part of the presentation.
Okay, so thank you. This is Michelle. Thanks for joining me today to learn about 3 impactors for your success. Thank you, Steve, for having me. This is a 2-part session, as we're going to be covering a lot of details on where you are today in order to help move you into a strategy for the future. Our goal for our session today is to understand current revenues, costs, and profits that you have from your financial statement and your systems reporting, and also identifying a few simple baseline targets for performance analysis. You will have access to a calculator after the session to analyze your own numbers based on our discussions, and the calculator is set to allow you to type in your own data in the yellow columns, which will then translate into performance analysis. Our agenda is going to cover profits, people, and partnering with clients. And the focus area for profits is, it should be what you consider what you have left at the end of the day to do something with. So you can choose to use these profits to invest in your infrastructure, invest in your people, or grow your retained earnings. And as we focus on people, it's important to understand that they are our highest cost. So how much each resource is paid is only one part of the puzzle. Where they're spending their time also has a direct impact on your success. And then recognizing that we do rely on your people to ensure client satisfaction and that retention with your existing partners. Our final focus area will be on building strong partnerships with your clients, which will directly impact your success. When helping your clients be successful, you in turn can be successful. And any numbers presentation with me, as Steve mentioned, it's going to be financial in nature. So I don't want you to be overwhelmed with what you're seeing, but in order to talk numbers, we have to have some frame of reference on where they're coming from. So this sample P&L are numbers that we're reflecting throughout the presentation. It's also included in the calculator if you're trying to back into where something is coming from. It's also important to recognize that this presentation of a P&L is not the perfect outline of a P&L. Your numbers could look different, they could lay out different, but we want to be telling the same story. We want to be categorizing revenue from product sales, that one-time hardware, software, to professional services, which would be anything that's more break-fix, some number that's fluctuating month to month, projects maybe, and then that managed services component, which would be that recurring revenue that you're counting on to be fairly stable as you go through month to month. I am including some sub-accounts for examples of managed services, which would be more in line with a categorization of the revenue as opposed to a specific service or a specific vendor that you're using to provide that service. So think of your own practice and know if you're breaking down and you want to see profit in a more focused approach on that managed service offering, think of how it's categorized in order to display it here on the P&L. As you look at the second part of this P&L statement, we do have a cost of goods section that mirrors the income accounts above. So again, we're looking for a one-to-one. If it's in product sales, we want to see the cost hit product cost of goods. If it's professional services, I am showing here a subcontractor labor line, even though I have zeros across there. But if you were using someone outside of your payroll to deliver services, ensuring that that hits cost of goods would be the best place for that in order for analysis. And then something that's a little different is, or you may not look at it the same way, is I do have a professional services payroll allocation here for compensation related to your professional services delivery. And then I have another payroll account under managed services. If you're currently running your payroll under expenses, that's perfectly fine. But in order to convey the calculator metrics and the numbers that we're trying to look at today, I did choose to display it here so that everyone could see where those costs were coming from when we're talking about people or resources. And then, of course, the managed services cost of goods. So that monitoring, Datto, Enable, Lab Tech, that cloud service offering, which might be Office 365, Azure, some sort of hosting, and then security services. We want to make sure that we're capturing costs in the right areas for the analysis to work. And then also think of any costs that you're incurring that are directly related to a managed service practice, meaning you may use IT glue in order to support your clients, but you're not necessarily reselling that. Including it here under managed services cost of goods will give you an accurate picture of how much it costs to offer that particular line of business. Burying it in expenses just makes it disconnect from where is it actually reporting on the financials and how do you get your hands around all those costs. So as we dig a little deeper into our agenda and focus on profit, I think it's important to know, yes, people are the major impacting of our profit numbers. That's that compensation, salary plus benefits, as well as the time that they spend supporting your managed professional services, and then any admin that they might have, admin time that they might be tracking. The second component of the profit impactor would be products and or services. So again, that's managed services, costs, contractor labor, and then any of that hardware or software for that one-time resale. And then the third layer that I think is important to consider in direct impact to profit is revenue. And this is something that you're in control of. This is something that you are setting in order to provide managed services to your clients or support your clients for professional services. That's important to know that you're setting that price. So whatever price you're charging your client is directly going to impact your profit. And then also understanding your client base. So who you're choosing to engage with will directly impact successful profits. You want to partner with clients that value you, that get what you do so that you can be successful and that they can be successful. And then that final component of revenue would be you're dictating and determining the billing rates that you are charging for time and materials, labor, or projects, whether they're fixed fee or billable by the hour. You're determining what that rate should be. And if it's too low and it doesn't work with the cost that you have to support it, then that's directly going to impact your profits. So in an analysis, we need to have some sort of baseline to work from, some sort of measure to pay attention to. And so what I'm presenting here are 3 targets. So target revenue by line of business to total revenue, target cost to total revenue, and then a target number for gross profit. You may be looking at this and thinking it's not in line with what you're doing today, but in order to go through this type of analysis, we needed to start somewhere. So as we break down the lines of business, our MRR revenue, we're expecting in this revenue mix to have a 55% revenue to percentage of revenue to the total revenue. In the professional services, we have it set at 30% to total revenue, and then we're not really considering the product layer as a part of this conversation due to focusing on what the managed service offering is doing versus what the product sales are doing. Your revenue mix might look different, and in the calculator, you absolutely can plug in the numbers that make sense for you and then test compare your performance to the actual targets that it's testing against. On the cost of total, the percentage cost to total revenue numbers, again, we're looking at lines of business. We want to see that in the case of 50% of the total cost to total managed service revenue, we want to make sure that that number is somewhere in line with 50% or lower. So you might say, I don't want to do 50% return on my revenue for MRR. I want to put it at 35%, and you absolutely can do that. You would be looking for ways to drive those costs down in order to get that percentage number target to be lower. And then the same is true for your professional services delivery. The last column of target percentage gross profit, again, by line of business, I would say that some of these numbers might be a little on the low side, but in order to set a baseline for everyone, I wanted to use something that might be more realistic to what people might be experiencing today. So as we break apart these numbers, we start to understand that revenue obviously is that driving force. It's what you're selling and getting that return from the sale. So again, by line of business, we're looking at a sample set of numbers where this particular company is at a little over 1 million for managed service revenue, and then the rest of their business is coming from professional services or products. With the assumption that we're trying to grow the managed service practice, I've set the target percentage of revenue at 55% for our revenue mix, so slightly higher than half. And if you were to add up the professional and product revenues, they would account for a little bit more than 50% at this moment. So in the mindset of we're trying to grow the managed service practice, maybe reduce a little bit on that professional services side, and then that product's going to continue to do what it wants to do, we would be wanting to set our target percentage of revenue by line of business a little higher. In this calculation, we're coming in at 50%, so we're a little off, a little lower than our target, but that would be a conversation that you would be thinking about. If you're going to increase your MRR revenue, how would you do that in order to make up that shortfall and start to flip your business from maybe professional services into managed services? The second component of what we're talking about in relation to profit would be dealing with costs. And I know that this is a huge pain point for our industry. Many clients that I work with are always saying, I can't get my hands around costs. They're always changing, they're always moving. And we need to expand where we're thinking of what are the costs of actually running our business? Where are we getting those? Where are they at on the financials? So when you start to do this process of reviewing your costs, I always say start with your vendors. Look at the services that you're providing. Who are the vendors that you're buying that, purchasing those services from? Where is that at on your financials? And oftentimes, because we're paying with credit cards, it's usually posted into some account in the expense section because the credit card statement came in and that's what the accounting team did. So always pushing on who are the vendors that we are using to provide our services and where is it being posted today so that you can get your hands around it. That's step one. And I always push people to think as you're finding these costs, it could be something that you would not have incurred in order to just run your business. It's something that's distinctively for your managed service practice or maybe your professional services. So as you're looking at your data, you're looking for vendors that you would be paying to provide services that you're then using to support your clients. And I would also encourage, as we think of costs, really assessing what we're paying our resources. So in this particular chart, I know there's a lot going on, but if you're looking at the costs on the left, we're talking about breaking apart where our resources fall. So are they a highly paid resource, high-end engineer? They would be in the tier 3 bucket. You might have some mid-level, tier 2s, and then that tier 1 group could be technical or it could be help desk. So think about where your resources fall and determine what's the average salary compensation cost that we're paying today. That's what would be going into the column that says average salary, and then it will calculate or distribute based on the number of resources that fit in that band. This is in the calculator that you're going to get. It's a fairly simple number. It doesn't have to be perfect, but just knowing that these are the people that are dedicated to my managed service practice. These are the people supporting me on professional services, and making sure that their costs are accounted for in the calculations is important. The fourth row, or in this cost mix that we're looking at here, is really focusing on the vendor managed services, and that could be the resale of a service, but it also could be the cost of having an outsourced help desk. If you are using contractors for labor, I would encourage putting that cost in here as well. And what we want to be doing is allocating these costs into the appropriate areas. So as you move across that chart, the two columns to the far right, one is saying, well, what is our cost allocation for monthly recurring revenue? And then what is our allocation for professional services? That allocation is coming from system reporting on time entry. It's not coming from what you necessarily think the person should be doing for you or why you hired them, but it's actually using reports from your time entry system to know this is where they're spending time. And I encourage people to look at not just did they track their time, but where did they track it? So if we're working for one account, that account has a managed service practice, managed service contract, as well as they get some project or professional services from you, being able to say, this is where the time fell whenever we're dealing with the managed service support, and this is where the time fell on the professional services project delivery, even though it's the same client, being able to see, here's how much time we're spending on them, and in these two core areas, this is what we're actually doing to support that account. As you look at time entries over the course of the month, you want to be breaking apart how many hours fell into managed, how many into professional. That's how you get the cost allocations into the right buckets. And then in the calculation, it's just going to multiply that and bring that down to give you a test against your performance, or a performance test against the target. So in this particular area, we are setting the cost to revenue percentage for MRR at 50%. In this example company, we were slightly over, so we're paying a little bit more for our MRR costs, and the same is true for our professional services. We're slightly higher. When you are analyzing your own data, thinking about what you might want to change, obviously we are always trying to drive our costs down, and so that's the focus of this particular conversation, is thinking about where are you spending money, what are the costs that are associated with the different lines of business that you have, and what can you do to slightly change that, or maybe more than slightly change that. The last area that is kind of focusing on this profit conversation is actually thinking of, well, what do the numbers tell me? So if we're thinking of lines of business, MRR and professional, we're looking at the revenue, we're looking at the costs, and that's service, outsource help desk, compensation costs. What would be our target profit percentages, and then where do we actually fall? And as you read across the sample company line of business for the MRR, their profit margin was 48%, which is low, not terribly low, but low. And then the professional services was slightly higher than where it should be. And so what this is telling me is that we might have the right mix of costs, we just might be allocating time into the wrong area. So maybe our professional services team is doing great, but maybe they're helping out on MRR side, so that's actually driving the cost up because they may be paid more than what we would expect to be costing against the managed service recurring revenue. Overall, as we look at the totals line, the profit of this company is at 50%. So if you're going to combine those two and average it, it's not a terrible profit margin. So, you know, they're making money, but if you're trying to grow managed services versus professional, you would be making some decisions on how to redistribute those costs so that it's more balanced. And I like to ask a lot of questions, and if anyone on the call has worked with me, I ask a lot of questions. But the questions that I would suggest that you consider as you're thinking about your numbers and what's impacting your success would be in relation to this profit number, or profit distribution, which would be people first. So do you have too many higher end resources? What is their compensation in relation to the services? Are they allocating their time correctly? So are they recording their time, and are you allocating their time correctly? And it could be that you hired a resource thinking they were going to drive a particular area of your service delivery, but then you go and analyze their time and you find, no, they're not doing that at all, and it's falling somewhere else. So thinking about what did you hire the resource for, and then where are they actually delivering services for you. Analyzing those service costs. We have a lot of vendors that we work with in order to provide managed services. So really truly looking at how much are you paying those vendors and what is the return on that. If you have a client that just has a one-off vendor that must be in place in order to support them, that's not maybe part of your core. You have to have a special team in order to support that particular service offering. You know, analyzing what's going on with that vendor and service cost is important. And then also making sure that you're aware of what the cost is, because oftentimes as you start to analyze the data, you might see that you're paying one vendor and you're paying another vendor for the same exact service, or maybe one vendor can do both of those particular service offerings, and so you're not really aware that there's two people that you're paying that are actually doing the same thing, and that's driving your cost up. And then that third component, again, revenue, understanding what you should be billing monthly for the services that you offer, knowing what your margin is that you want it to be, and is that the right price that you should be charging your client in order to get that return. Understanding your client base, so an increase or a decrease, both can have a negative impact on profits. And I think oftentimes people are striving to just bill more, just get more recurring revenue, but they're forgetting that it's going to cost more. You have more services, you might have to have an additional team or expertise. So more revenue doesn't always mean that you're more profitable. And then the same is true as if you have a client base right now and you're not profitable, decreasing that client base. Maybe you have a client that just doesn't get what you do, so decreasing it will actually increase your profit, because now you're not spending time supporting that client that's just not fitting. And I do find that the longer you've been in business, the more room for that. It's very prevalent. And anytime you're looking at your clients and you're saying, well, this client's been with me for 15 years and this one is new, the 15-year client might not be very profitable for you because they're just not growing with you. They're still doing what they were doing 15 years ago. So it's hindering you from being profitable. So thinking about your client base and how that's impacting profits is very important. And then that last question of, should I increase professional services rates? So thinking of, what are you billing now? If you're continuing to deliver on professional services, is it hourly? If so, should that rate increase? Should you be charging a higher minimum? Maybe you were 15-minute increments before, now you're going to round that to 1-hour increments. So thinking about how that professional services revenue is being charged. And then if you're shifting more into a fixed fee, a milestone type approach, really knowing what does it cost to do this particular installation or deployment or onboarding. It's very important that you are able to analyze both from a time and a cost standpoint, what is it going to take, so that when you set that price with the client, you're actually profitable on those professional services. Our last component, our piece of this, and it was interesting on the presentation we just heard for backups, that client partnership, bringing that value, it's the new approach, I would say, into the technology space, but it's so critical. And it's important to remember that our clients have a direct impact on our success, and having that strong, trusted relationship that you're working to grow is what's going to start that process in the right direction. And then as you are thinking of, what am I doing to strengthen my partnerships with my clients, don't forget that what you do internally, so that system that you're using, the way that you deliver services, the way that you communicate with your clients, all of those pieces are playing a role in that partnership, and you want that to be a very positive experience, and you want that client to want to work with you, which leads you into focusing on that client satisfaction. Your team, your people They are the face of the organization. In most cases, they're the ones dialoguing with the client. So everyone from that first ticket triage all the way to closure and billing, every team member is playing a role in that client satisfaction conversation, and making sure that you do invest in the organization to ensure systems are working, processes are working. The team understands that this is the way that we have to support our clients so that our clients are happy, which means they stay with us and they can continue on growing that partnership. It's absolutely critical. There's just too much competition out there right now in our technology space, and it's only going to increase. So making sure that you have something that is focused on that client satisfaction layer is going to put you in the running for success. And then that final component of showing the value, it's a nebulous undertaking, I think, when you start to think about what am I doing to show value to the clients. And in our technology space, we're typically getting an issue, we're hearing something is broken, we go and fix it, and then we move on. So the client's experience of what is the value of partnering with you has to be known. You have to be communicating that in some way, because oftentimes, especially with that managed service layer, they don't even know that you're doing anything throughout the month. They don't see it, they don't hear it, everything's working, so there's no problems. So it's very hard to make sure that that value conversation is happening. And we will definitely deep dive into some ideas on what you can do in our follow-up session. But the biggest approach here is spending some time with the client to get to know them. So not just talking about what you did, what problems you resolved so that they were able to do their business as usual, but also getting to know what's keeping them up at night. What are they worrying about? It may have nothing to do with technology. Everything might be working, but if you understand what's plaguing them and what they are fighting up and what they're battling up against, you will go a long way to strengthening that partnership, which continues that loop of building client satisfaction and retention, and you can keep that relationship growing for the future. I know we covered a lot, and as Steve always says, talk fast. So I definitely want to make sure that we're taking away some key points, and you have a tool set to be able to analyze your data and know this is where I'm at right now. If you join me on our next session, we're going to talk about, okay, what happens when we change something? And it could be lots of variables that we're changing. So knowing the numbers, taking that time to go find the data, where is my revenue? Where is it falling today? Is it accurate? Am I billing for everything? You know, that whole conversation of what's happening to get the revenue over to the financials. And then the second part of that is knowing what your targets might be. So in this presentation, I'm going with some very vanilla samples, if you will, but standard samples. If your numbers are different, then in the calculator, plug the numbers that make sense for you so that the comparison is actually telling you the right story. In the second takeaway from this would be understanding your costs in order to make better decisions. So if you know where your costs are and you can identify them, then you can make decisions about it. So definitely taking some time to find it, even if it's painful, it's very important, because if you don't know what you're paying for, then you can't really make decisions on how it's impacting you. Determining where your resources are working for you today. Know that you hired someone not to be an admin person typically. You're hiring them to deliver services. So that's what you want to see first. And then you want to look for in the system, okay, where did they deliver the service? If you're finding that someone is putting most of their time to admin, a small amount of time to the client, then that's a different conversation. You're still going to allocate that cost for the admin time to one of the buckets. You don't get a pass on that. So you're still paying it to figure out where you would want to allocate their time, but then having that conversation with the resource saying, okay, we didn't bring you in to do internal meetings and check emails. We need you to support the clients. So pushing on them to get time entered accurately is critical. And then focusing on more than revenue. So thinking about revenue in a sense of if it increases and you go with, I'm going to do a 4% increase year to year, what does that really do to the costs? In some instances, that is just an increase in revenue. You're not changing anything. But in other instances, like you're adding more licenses or you're adding a new service offering to the client, your costs are going to change. So being able to recognize that a revenue change, what's the impact to cost? Is that the decision? Is that the best decision for you at that moment? Because at the end of the day, it's going to impact the profits that you have to take to the bottom line. And just thinking of profit in this conversation, I know in lots of peer groups, and I'm not saying anything for Steve's peer group, but if you're not thinking of revenue and profit, then you're going to have a one-sided conversation. So thinking of what's going to happen to my profit, how do I get more of it? Because that's what I have left to do something with. So that's giving you that freedom to invest, to grow, and all those things that you want to have in your business. I wanted to thank everyone for joining me today. I know we covered a lot, and I do encourage everyone to come back for the second session, which I believe is in June. What I'd like to do there is talk about the impact of profit on profit whenever you're growing your managed services, also using the forecasting calculator to make some projections that would impact your success, determining resource burden costs and how that impacts your revenue that you're billing for, understanding utilization and in relation to the cost and profits, and then also talk about some ideas for strengthening your client partnership and the value-added services that you can offer. So I'd love to have everyone come back for that, and we get to spend a little more time together. I think I'm going to open it up for questions.
So we have a couple posted already, Michelle, and why don't you leave this slide up instead of the Q&A slide so people can make sure they get your contact info.
Okay.
Early on when you were talking about the cost of goods sold with services, this question comes up all the time in group, and someone said, well, for managed services on the payroll side, what about a manager's payroll?
Mm-hmm.
Now the question wasn't specific, but you know, a service manager, for example, is that cost of goods sold or overhead?
So if you have that service manager just to run your service business, then I would encourage thinking about them in the cost of goods area. If your service practice went away, would you still have that service manager cost? That would be the question that I would ask. If you say yes, they're going to do something else, then it would be below the line, it would be SG&A. If not, then it would go to cost of goods.
And if they're a split role, because most small MSPs, then really you should consider it that way too, right?
Mm-hmm. Absolutely, yes.
I pumped my fist because you did answer the way we answer all the time. So I was excited that you didn't contradict, because we're not always right, as you know. You know, in a managed service environment, and I struggle with this all the time with our groups, we live in a tool-centric environment where engineers who are MSP owners are, right? They're technical resources that grew. They tend to always look for, well, where's the plugin to fix this problem? Where's the tool to fix this problem? And I was asked a question in the Q&A, or you were asked a question in the Q&A that I almost wanted to scream because I don't want to ask it, but I want to hear your thoughts on it. And someone said, well, it would seem to me that most managed service practices are very similar. So is there a sample chart of accounts that we should all be using that's exactly the same for every business, or at least as a starting point?
So my answer would be the sample that I included for revenue and cost of goods would be a good starting point. But I do think that it's unique, and it does depend on what type of business model you have. So there is that caveat that a sample chart of accounts or base chart of accounts is going to change with the way that you are measuring your business.
Correct. We actually we give a sample that we've had for years. Mm-hmm. And, you know, it's just one of our more mature MSP members that we say, sure, we're going to share their chart of accounts for everybody. We've done that for years. It's been available to our members. Those that don't know it, it's probably in your team's files sitting there waiting for you to look at. But I also believe that whether it's your accountant, whether it's reaching out to VPA for some guidance, you need to look at your specific business and understand how you want to record things. Is that fair?
Yep, I would agree.
Great job. I love the information. Is there a standard for an owner of a small MSP to take their own salary into account? We find so many small companies actually take it as a distribution and don't count it, and then say, look at my profit, look how good we're doing, except they haven't accounted for their own salary in there.
Yeah, I actually structured the sample where I might be assuming that the tier 3 resource could be the owner. So a portion of the time being spent doing professional services and then a little bit managed, but it was a higher paid compensation. And I would go through the same process of, if you're the owner and you're delivering on the services, give yourself the right allocation, so have some awareness of where you're spending your time, and the portion that's for professional or managed service delivery, account for it. The rest would go in SG&A and be just part of the cost of running your business. But I would encourage putting it in, seeing where you fall, and then if you still want to pay yourself out at the end of the year, however you want to work it, that's fine. But I would encourage putting it into the numbers throughout the year.
Sounds good. Thank you very much. Okay, well, we're about out of time. Most of the attendees on this call are actually peer group members. So feel free to shoot me questions for Michelle or grab her contact info and schedule some time, or request some time to have Michelle come visit your peer group, and we'll arrange for that, because she is available to come and speak directly to a group. And we have her again next month on another session to finish this one up. So I want to thank everyone for their time today. Hopefully you received some information that was actionable and helpful. For those not already participating in one of our peer groups, reach out to us. We'd love to have you. Michelle, Mike, thank you both for your time and expertise, and we'll see everybody again next month.
Thank you.